Welcome to today's deep dive. We're really thrilled you're joining us today because we have an incredibly counterintuitive and frankly somewhat jarring topic to explore with you.
Yeah, it really is. It's one of those things that just kind of stops you in your tracks when you first see the data.
Right. We're looking at the quantifiable historical relationship between global armed conflict and the stock market. Now, we all know the visceral reaction when a major conflict breaks out. I mean, the news flashes red, commentators immediately start forecasting total economic catastrophe.
And the overwhelming instinct for the average investor is just to smash the panic button.
Exactly. Just liquidate the whole portfolio, hide the cash under the mattress.
Yeah.
But when you actually strip away the emotion and look at the raw data, a completely different story emerges.
It is a genuinely surprising story. And it flies in the face of, basic human intuition. Whenever geopolitical tensions boil over, the immediate assumption is that financial markets will just endlessly plummet into the abyss.
Right, because that's what it feels like.
Exactly. But when you look past the dramatic headlines and actually study the empirical historical patterns, a much more complex, resilient reality comes into focus.
And to help you navigate this reality, we are pulling from a really comprehensive synthesis titled The War Economy Puzzle: Why Stocks Often Rise After Invasion.
Yeah, and the data here is just phenomenal.
It really is. This material aggregates over a century of data from some seriously robust institutions. We are talking about deep quantitative research from the Swiss Finance Institute, strategic historical analysis from Cook Wealth Management, sector insights from the Motley Fool, and institutional capital flow data from Nedbank Private Wealth and Invesco.
It's a massive data set. I mean, we are looking at market behaviors spanning World War I, World War II, Korea, Vietnam, the Gulf Wars, Afghanistan, Iraq, and the 2022 invasion of Ukraine.
So our mission for you today is highly specific. We're going to decode why markets actually seem to recover and often rally, surprisingly, when war officially breaks out.
Right.
We're going to map out the hidden asset rotations happening behind the scenes, looking at where the smart money moves. And ultimately, we want to equip you with an analytically grounded framework so that you don't make emotionally destructive portfolio decisions when the geopolitical landscape feels the most uncertain.
Which is when it's the hardest to stay rational.
Exactly. And I want to set the tone right up front here. War is a terrible human tragedy. There is absolutely no minimizing the catastrophic human cost of these events.
No, of course not.
But our focus today is strictly on understanding the mechanics of financial markets.
That distinction is crucial. The goal here is to remain entirely analytical. We want to understand how capital flows during a severe geopolitical crisis to, help protect your financial future by spotting the patterns history has consistently laid out for us.
Okay, let's unpack this. There is a core finding in the research from the Swiss Finance Institute, and it's known academically as the war puzzle.
The war puzzle. Yeah.
The paradox is this. Broad stock market indices typically suffer significant drawdowns in the lead-up to wars, but they actually pivot and rise after the hostilities officially begin.
Which is wild to think about.
On the surface, that sounds completely backward. Why would the market reward the actual start of a war?
What's fascinating here is the fundamental nature of what markets are actually doing behind the scenes. You have to remember that Wall Street algorithms don't have a conscience.
Right.
And they certainly don't have a political affiliation. They just have risk-weighting models. Markets are, at their core, pure uncertainty pricing mechanisms. Every single asset price you see on your screen is just a probability-weighted assessment of future states.
I see the logic, but wouldn't the future state of a war include, mass destruction of capital and disrupted supply chains? Why wouldn't the market just price in total systemic failure?
Because of the phase shift between two very different types of ambiguity.
Two types of ambiguity.
Yeah. In the pre-war period, when tensions are escalating, you have massive existential ambiguity. Will an invasion actually happen? Will back-channel diplomacy work at the 11th hour? Will the conflict metastasize and draw in neighboring superpowers?
And markets hate that.
Markets absolutely hate this. The standard deviation of possible outcomes is enormous, and that existential uncertainty acts like a massive gravitational pull, just dragging equity valuations down.
But then the first shot is fired and that existential ambiguity vanishes.
Precisely. The moment the war officially begins, that probability range collapses. The absolute worst-case scenario that the market was agonizing over has now materialized.
So the waiting is over.
Exactly. The existential ambiguity is suddenly replaced by analytical ambiguity. And markets are incredibly efficient at dealing with analytical ambiguity.
Because they can finally do the math.
Right. They can instantly start modeling quantifiable metrics. They can project the geographic containment of the conflict. They can model specific supply chain bottlenecks, and they can calculate which specific domestic sectors will absorb the redirected government spending.
It's a brutal irony. If you panic sell the morning troops cross a border, you aren't actually avoiding the crash.
No.
You're just finalizing your losses at the exact second the market has finished pricing in the worst-case scenario. You are selling at the point of maximum uncertainty, right as the analytical fog is starting to lift for the institutional models.
That is exactly the trap retail investors fall into. They sell the news, completely missing that the institutions sold the rumor 6 months prior and are now buying up the newly discounted assets.
Let's ground this theory in history's clearest lessons. There's really no bigger test for the war puzzle theory than World War II. In September 1939, when Hitler invaded Poland, triggering the most destructive conflict in human history, the U.S. stock market did not crash. According to the historical data from Nedbank Private Wealth, the U.S. market actually climbed 10% in the immediate aftermath.
10%. It perfectly illustrates the dynamic we just broke down.
But why? Why did equities climb while Europe descended into chaos?
Because geopolitical tensions had been building on the continent for years.
Yeah.
You had the annexation of Austria in 1938, the occupation of Czechoslovakia.
Right, it wasn't a secret.
Exactly. The market had endured 18 months of bleeding out the uncertainty. The pre-war uncertainty discount had already done all of its structural damage to the market long before September 1939.
So the actual invasion of Poland brought modeling clarity.
Yes. Investors could finally start assessing which U.S. industrial and manufacturing bases would benefit from wartime production orders.
But the data shows a completely different reaction in December 1941 with Pearl Harbor.
Very good.
This was a total surprise attack that dragged the U.S. directly into the Pacific theater. Because it was completely unexpected, there was zero pre-war uncertainty discount priced into the market. So the Dow Jones took an immediate hit, dropping 2.9% right out of the gate.
The crucial detail there, however, is the recovery trajectory. Even after a catastrophic, unpriced surprise attack like Pearl Harbor, the market absorbed the shock and recovered within a month.
Just 1 month.
Yeah. And if you zoom out and look at the full duration of the conflict, by the time World War II ended in 1945, the Dow was up roughly 50% from its wartime lows.
50%.
Yeah. An investor who liquidated their portfolio in December 1941 missed one of the most significant wealth-generating equity rallies of the 20th century.
And we see that rapid recovery pattern repeated with other surprise conflicts. Look at the outbreak of the Korean War in 1950. It caught the market completely off guard, resulting in a sharp initial sell-off. But equities stabilized within weeks. Over the full course of the Korean War, the S&P 500 rose 60%.
It is a profound historical rhythm. The initial shock of a surprise conflict always hits the tape hard because the risk wasn't actively modeled.
Right.
But the recovery is remarkably swift as the new geopolitical reality gets priced into earnings multiples.
So what does this all mean for you as an investor managing a portfolio? It means that understanding whether a geopolitical event is anticipated or a surprise completely reorients your expectations.
Completely.
An anticipated war means the damage is likely already baked into your portfolio before the first headline even drops. A surprise war guarantees a sharper initial drop, but the empirical data tells us a rapid recovery almost always follows.
Which brings us to how these dynamics play out in the modern era, where the velocity of information, algorithmic trading, and capital deployment is infinitely faster than it was in 1939.
Here's where it gets really interesting. Let's look at the September 11th attacks.
Okay.
Following that massive surprise shock, the S&P 500 dropped 14% in the first week of trading. It was a violent repricing.
Very violent.
Yet, driven by swift Federal Reserve liquidity injections and congressional stimulus packages, the market recovered to pre-attack levels in just over a month.
The 9/11 case study is incredibly valuable because it perfectly illustrates wartime sector rotation. Underneath that broader index-level recovery, massive institutional capital shifts were happening.
Yeah, the Motley Fool's analysis highlights this beautifully. Airlines, hospitality, and insurance completely cratered because travel demand evaporated overnight.
Right.
Meanwhile, defense and traditional security firms surged. But more importantly, the 9/11 attacks birthed an entirely new, sustained investment theme that institutions piled into. Cybersecurity.
Exactly. The sudden, terrifying awareness of digital infrastructure vulnerability drove a massive decade-long growth supercycle in that specific sector.
That underlying sector rotation is huge. Now, let's contrast the surprise of 9/11 with the Russian invasion of Ukraine in 2022.
Right. A very different scenario.
This was highly telegraphed. Western intelligence agencies had been publicly broadcasting the military buildup for weeks. Because of that expended pre-event information period, the initial stock market blow was somewhat softened compared to what you might expect from a major land war erupting in Europe.
If we connect this to the bigger picture, we have to examine why 2022 was still so incredibly disruptive to global equities, despite being widely anticipated.
Yeah, why was it?
It all comes down to the macro context. The invasion triggered unprecedented financial weaponization. We saw the removal of Russian banks from the SWIFT international payment system and the freezing of the Russian central bank's sovereign reserves.
Which had absolutely no real historical precedent in modern financial plumbing.
None.
And the energy shock was violent. We saw the TTF natural gas benchmark in Europe spike to multiples of its pre-crisis level.
Exactly. The TTF pricing basically broke. And crucially, all of this energy disruption happened in a global market that was already structurally tight from years of pandemic-era underinvestment in fossil fuels.
Right. The supply chains were already a mess.
And central banks were already being forced into aggressive rate hiking cycles to combat sticky inflation. So the critical lesson here is that wars do not happen in an economic vacuum.
They really don't.
The pre-existing macroeconomic conditions, specifically inflation levels and central bank liquidity, always dictate the severity of the market's reaction.
That is such an important nuance. You can't just analyze the battlefield. You have to analyze the monetary policy surrounding it.
Exactly.
Let's pivot and talk about where the capital actually flows when these crises hit. I want to guide you through the institutional flight to safety because different asset classes behave very differently outside of the standard S&P 500.
Gold is obviously the historical default.
Yeah.
It is the oldest safe haven because it lacks counterparty risk. It's not tied to any single central bank's monetary policy or government credit rating. For instance, in the first year of the Afghanistan conflict following 9/11, spot gold prices rose 9%.
So capital naturally flocks to it when systemic uncertainty surges.
It does. But the data from Invesco carries a strict warning here. Gold's geopolitical premium is highly transient.
Really? Transient?
Yes. Once the geographic scope of the conflict is defined and institutional risk appetite returns, that capital flows right back out of gold and into productive assets.
Now, I get the flight to safety regarding government bonds, but given that inflation often spikes during wartime, which absolutely crushes fixed income returns, why do institutional investors still flood into U.S. Treasuries the second a conflict starts?
It is purely about the liquidity premium. In the initial days of a crisis, massive asset managers aren't looking for real returns.
They just want safety.
They are looking for the deepest, most liquid market on Earth to park billions of dollars overnight without moving the price. That is the U.S. Treasury market. The influx drives bond prices up and yields down temporarily.
But I'm assuming that inflation risk catches up.
You are absolutely right about the inflation risk, which is why Invesco's data shows that this Treasury parking spot is very short-lived. Once the initial shock is absorbed, that capital violently rotates back to higher-yielding equities to outpace wartime inflation.
Then there is the currency market, which prices in geopolitical risk faster than almost anything else. The U.S. dollar almost universally strengthens during a crisis. It's the world's primary reserve currency. But that strong dollar acts as a wrecking ball for emerging market currencies, especially developing nations heavily burdened with dollar-denominated debt.
It's devastating for them.
And conversely, conflict-adjacent currencies just fall off a cliff. We saw the Russian ruble briefly lose roughly 30% of its value against the dollar in the immediate aftermath of the 2022 invasion as capital fled the region.
And we cannot map capital flows without diving into the energy sector. Conflicts in major hydrocarbon regions cause immediate supply fear premiums.
Like what we saw with WTI crude.
Exactly. Yeah. During the first year of the Afghanistan war, WTI crude jumped over 31.3%. But what Koch Wealth Management points out as truly critical here is the concept of the geography of benefit.
The geography of benefit. That is a fantastic framework. How does that practically play out for an investor?
It means the location of the asset matters just as much as the commodity itself. Look at the 2022 European gas crisis. Russian supply was effectively severed from Europe.
Right.
But energy companies, with assets safely outside the conflict zone, printed money. U.S. LNG exporters and North Sea producers saw incredible margin expansion simply because their extraction sites and supply routes were geographically secure, allowing them to step in and fill the massive European demand void.
Now, obviously, the most predictable retail trade in all of this is the defense sector. The logic seems foolproof. War creates government demand for hardware, so you buy Lockheed Martin, Raytheon, or General Dynamics.
Oh, yeah.
But it's actually not a foolproof trade, is it?
Far from it. Nothing screams, "I don't understand algorithmic front-running." Quite like a retail investor logging into their brokerage account to buy a defense prime the morning an invasion is announced.
Because the big players are already there.
The institutional algorithms beat them to that trade months ago during the tension-building phase. Furthermore, procurement cycles are incredibly long. A government announcing a new defense budget doesn't translate to immediate revenue. Those order backlogs take years to realize.
Right, they're not getting paid tomorrow.
Exactly. Additionally, strict ESG mandates increasingly complicate institutional holding of these stocks, limiting their multiple expansion. Historically, defense outperformance peaks very early in the conflict cycle.
Here is a genuinely surprising data point from the research that I found fascinating. Small-cap stocks historically outperform large-cap multinational indices during sustained conflicts.
It seems completely counterintuitive. You would assume investors want the fortress balance sheets of massive, stable companies during a war.
Right. But small caps consistently outperform for a few very logical reasons. First, they rely heavily on domestic revenue, which means they are largely insulated from the global shipping lane disruptions and cross-border tariffs that hammer large multinationals.
They just aren't exposed to those global bottlenecks.
Exactly. Second, they are organizationally agile. They can pivot their supply chains quickly. And third, they frequently pick up the specialized high-margin military subcontracts or logistics, software, or drone components that fly under the radar of the giant prime contractors.
That domestic agility is a massive structural advantage.
Okay, so we've mapped out the historical data, the sector rotations, and the capital flows. Now I want to shift the focus directly to the behavioral side of this.
This is the hard part.
It really is. When the VIX is spiking to 40, the tape is blood red, and the news cycle is terrifying, why is it so incredibly hard for us to just execute a rational strategy?
Because human beings are biologically wired with behavioral biases that are actively detrimental in financial markets. The two biggest psychological hurdles here are recency bias and loss aversion, and they interact terribly with modern market structure.
Okay, let's start with recency bias.
Recency bias is the cognitive trap of believing that whatever's happening right now will just continue linearly forever. When markets gap down violently, your brain tricks you into believing they will literally drop to zero.
And how does loss aversion compound that panic?
Well, foundational behavioral economics, citing Kahneman and Tversky here, proves that the psychological pain of losing $10,000 feels emotionally twice as intense as the joy of gaining $10,000.
Twice as intense.
Our brains weigh potential losses far more heavily. So during the conflict onset phase, when the downside feels existentially threatening, loss aversion drives retail investors to liquidate at any price just to stop the emotional pain.
They just want it to end.
Right. What they don't realize is that their panic selling often hits institutional algorithmic stop losses, triggering cascading margin calls, which creates an artificial temporary market bottom that the smart money immediately steps in and buys up.
So to combat our own psychology, we need an actionable, rules-based framework. Let's weave this into a historical playbook based on a century of data.
Good idea.
If we look at the timeline of any of these conflicts, that escalation window, the weeks or months before a shot is actually fired, that is mathematically the most dangerous place for your portfolio.
Exactly. Because of the uncertainty discount we discussed earlier, during this pre-war phase, the data suggests actively trimming emerging market exposure, especially in conflict-adjacent geographies, and rotating that capital into safe havens like short-duration government bonds or temporarily into gold to dampen volatility.
But the math clips completely once the first 30 days of actual conflict hit. The primary rule here is do not panic, sell into the algorithms.
Do not do it.
You use the volatility. This is historically the time to overweight energy, keeping the geography of benefit in mind, and strategically acquire quality equities at a steep geopolitical discount.
And as the conflict stretches into the established phase, months 1 through 12, you broadly maintain your equity allocations. You normalize your safe haven bond holdings as the analytical ambiguity resolves, and you hold your ground.
Which brings us to the post-conflict phase. This is where Cook Wealth's data on the reconstruction trade comes into play.
Reconstruction trade, yeah.
Historically, the rebuilding of shattered nations triggers massive debt-fueled economic stimulus. We see aggressive capital rotation into industrials, heavy materials, concrete, steel, and physical infrastructure as the rebuilding begins.
Which leads to the absolute most crucial, data-backed takeaway from all of this research, spanning from the trenches of World War I to the drone warfare of today.
What's the takeaway?
In both peace and wartime, history overwhelmingly favors those who hold.
History favors those who hold.
Unquestionably, individual companies may go bankrupt. Regions that are physically decimated may suffer permanent capital destruction, but broadly diversified equity portfolios consistently absorb the shock, recover, and grow over a rolling 5-year horizon.
Wow.
If you let loss aversion dictate your strategy and sold at the outbreak of World War II or the morning of 9/11, you permanently locked yourself out of some of the most powerful subsequent wealth-building rallies in global market history.
To summarize this deep dive, while geopolitical conflict feels existentially terrifying to us as human beings, financial markets strictly price probabilities, liquidity, and uncertainty. They do not have emotions.
They really don't.
By understanding the underlying mechanics of institutional sector rotations, by recognizing the critical difference in how markets price a surprise shock versus an anticipated event, and most importantly, by short-circuiting your own psychological biases, you can navigate these severe crises rationally.
This raises an important question for you to mull over as we wrap up. We discussed how post-conflict periods reliably trigger a physical reconstruction trade, that historical rotation into concrete, steel, and heavy industrials.
Right.
But look at the anatomy of the 2022 conflict. We saw the unprecedented weaponization of the SWIFT international payment system, the freezing of sovereign central bank assets, and the terrifying rise of state-sponsored cyber warfare targeting national grids.
It was a very different kind of battlefield.
Future conflicts are increasingly, and perhaps primarily, digital. So when the next major global conflict concludes, will the lucrative reconstruction trade completely shift away from physical infrastructure?
That's fascinating.
Will the capital instead focus entirely on rebuilding shattered sovereign financial systems, upgrading digital networks, and fortifying cyber defenses? And if so, how exactly do you invest in the physical rebuilding of an entirely digital economy?
That is a brilliant and incredibly complex thought to leave on. The fundamental nature of war is rapidly changing, and the institutional reconstruction trade is going to have to evolve right along with it. Thank you so much for joining us for this deep dive into the war economy puzzle. We hope this analytical framework helps you cut through the emotional noise the next time the geopolitical headlines flash red. Keep learning, stay rational, and always stay curious.